In my sector in particular, it's been pretty bearish, to be honest. I operate in the capital market. I think for better or for worse, I think worse today, but better in the future. The first crop of InsurTechs didn't quite pan out. It's a lot more kind of show, don't tell in InsurTech. I think right now it's much more, what have you done? What's happening right this second? What can you prove?
Hi, everybody. Welcome to the next episode of Future Focus CXOs. I have a very exciting guest today, Marc Frenkel. He's the CFO for Corteria Insurance. And without further delay, let me welcome him to the podcast.
Awesome. Jay, Steve, thanks for having me. And I think there's a saying in the insurance industry that no one actually chose to work in insurance. They just somehow fell into it. I started off in investment banking, spent some time in private equity, and then just fell into the turnaround side of insurance because my investment banking background was with distressed companies. So I fell into it, was drawn to the complexity of insurance. I think a lot of people, when they interact with insurance, it's with an insurance salesperson and it feels like a straightforward vanilla process. But in reality, insurance is incredibly complicated, intellectually stimulating, and especially when insurance companies have issues, unraveling those knots can become very interesting. Found my way into the InsurTech world, where ironically, startups and distressed companies look very similar when you look at their P&Ls or balance sheets, except startups are on the way up and distressed companies are on the way down. That skill set has served me pretty well, especially in the current capital markets environment.
So what sets Corteria apart? And why is it you're so enthusiastic about this as opposed to working in other areas of insurance?
To be honest, I, for a long time, never thought I'd work in InsurTech because my time in doing turnaround work within the insurance industry always taught me that insurance companies that grew through underpricing risk, basically charging less on premium for the same amount of risk in order to grow, is a short-term positive, long-term negative that ultimately leads to calling in people to come clean up the mess. So when I first came across the InsurTech industry, I think a lot of the first movers were not truly solving a problem. They were making incremental change to what was already out there and ultimately underpricing risk. And for that reason, I wasn't too bullish on it. Then I came across Coteria. And what sets Coteria apart is that it's actually solving a problem in the insurance industry. It's trying to sell insurance to people who otherwise, prior to Coteria, were not being sold insurance. We focus on micro, small commercial customers. So think of main street stores, someone printing t-shirts in their garage, two-person artisan contractor that installs toilets. And insurance is sold through agents who collect a percent of the premium. When the premium is very low, call it $1,000, and the agent has to spend 5 hours from start to finish getting that policy quoted and bound, they may not think the $150 they're making is really worth their time. And as a result, a humongous swath of the US economy went underinsured, not because they didn't want insurance, but because distribution was not incentivized to sell to them. And Coteria sought to directly address that challenge by effectively making it much quicker and easier for agents to sell insurance to the smallest of the smallest customers. That's how Coteria has managed to carve out a niche where it's not competing against legacy incumbents who are tough to displace, and is pricing risk adequately.
So you tend to do that both with captive and individual agents?
We do it more so through independent agents, digital agents, wholesalers. We work with agents that have no obligation to work with us. It's more that we'll go to them and we'll say, hey, how often are you coming across really small customers where you could make some commission on them, but the amount of time it'll take to make that commission is not worth your time? And nearly any agent will tell you, yeah, like that happens actually fairly often. And we'll say, all right, how about we can give you a system that will allow you to go from submitting the application, quote unquote, to getting a bindable quote and binding it in less than 5 minutes. And they'll say, if you can do that, we're all in, because we're actually solving a problem for them.
Okay. As a CFO, how do you shift from your core role as a finance controller to really building the systems and thinking about systems? Because as you very rightly said, the amount of money that the insurance agent is making is not that significant, right? So more and more automated and more quickly you can make it happen, more and more incentivizes them to do it.
I love that question because I spend a lot of my time thinking about, I'll call it business model engineering, where you need to do a lot of things right to generate cash flow. especially with the problem that we're trying to solve. And so let me try to explain it this way. Let's say that you want to start a business like Coterie did, selling insurance to the smallest of the smallest customers. First thing you've got to do is you've got to give agents an incentive to even sell on your behalf. So that's what I've talked about. That's what we've done already. The second part is you have to generate that premium at a good loss ratio, because as an MGA, as basically an agency that empowers other agencies, we don't actually bear the premium risk. That's what large insurance carriers do. They're the ones who take the cash and they bear the risk of the claims. And no one wants to basically put our policies on their balance sheet if they're going to collect $1,000 in premium and pay out $1,200 in claims. That makes no sense, right? So we have to make sure that as we sell this premium, we're adequately pricing risk so that ultimately the loss ratio is attractive to insurance companies and they'll actually pay us a commission for generating this premium for them. And now let's say you can do both those things. You could generate premium, and then you could also convince insurance carriers to want this premium and pay you for it. Now you've got a third challenge. This is where things get interesting, which is how do you control your expenses? If you're selling lots and lots and lots of small policies at a really high velocity, that's a lot of touch points. That's a lot of interactions with your customers. And interactions with customers give rise to, absent technology, it gives rise to demands upon your workforce. It means that people have to go and execute those routine interactions with your customers. And this has been a problem that's plagued this part of the insurance market for a very long time, because it's no secret that this has been a massive pocket of value that's yet to be captured. The largest insurance companies know it. And when they are able to generate this premium, they might do it at a good loss ratio. Call it, they pay out 50 cents on the dollar in claims, but then they'll spend 55 cents on the dollar on allocated expense among personnel to underwrite, to service, to handle billing questions, to change addresses, additional insureds, endorsements, all the routine stuff that happens on day 2 of a policy. So the challenge that I face is now that we've managed to achieve product market fit, we've managed to grow rapidly. How do we now optimize our expense structure such that we can get to cash flow break even? And we do that by investing in technology that automates many of those interactions that we have with our customers, so that as we grow premium and revenue, our headcount, i.e. our expense, won't grow in lockstep. And we'll achieve cash flow break even through effectively an economy of scale.
Very cool. How do you deal with issues of climate change, mass events, and the rising interest rates? I know insurance carriers are going up 30% in some states every year. And like, how does that blend with the way you're being able to manage this particular risk analysis to make a profit?
How do you adequately price for someone's property insurance when you're not sure how many once in 100-year hurricanes are going to hit their property this upcoming year? And I think right now the answer that I've observed is that much of the insurance industry is somewhat in paralysis with regard to how to handle this. There is no way to properly price it. And because insurance is highly regulated, you can go to a state regulator and say, I think the right price for insurance is X because I think we're going to have 2 once in 100-year hurricanes hit Florida this year. But regulators might say, no, we disagree. And then you're at an impasse. So I think what we do, because we're fortunate that we're penetrating this massively underpenetrated portion of the insurance market, we're just basically avoiding those areas where there is a lot of catastrophe risk, or insurance parlance, cat risk. It's a luxury we have because we're not competing in a highly competitive market. Again, we're carving out a market that's never quite existed before. But as a result, I think there are, unfortunately, large swaths of the country where we'd like to provide insurance, but because the pricing and the regulatory regimes and just the uncertainty around natural disasters are just not in alignment, it's very hard to convince insurance carriers to take that premium if we generate it for them on their behalf. Interest rates, super interesting. Because interest rates for a very long time were very low. I think an entire generation of executives, finance people learned how to think about business in a low interest rate environment. And then suddenly it flipped on its head and all the rules changed. And what does that mean? It means that once upon a time, if you had an idea and it had product market fit and it had a good TAM and you had your first customer, you could sell somebody that you're going to build a business that will make a large return in 3 years, in 4 years, in 5 years. And that was okay, because when rates are low, the discount rate on that future cash flow is low, and therefore it's worth not too dissimilarly in the present as it would be in the future. That all changes with interest rates. Now, if I'm trying to pitch a story that will generate a return in 2026, that's being heavily discounted to today. especially when investors have the option of investing risk-free at 7%. So as a result, we have to think about every use of capital in terms of what generates an ROI this year. How do we stop looking at kind of pie in the sky ideas? You can never stop. As technology innovators, if you stop thinking big picture long term, I think you have other issues. But how do you shift the focus more than in the past to ideas and initiatives that can pay off this year? And a lot of that comes through automating parts of your expense structure, figuring out how to basically put in place processes where you can keep on growing and growing the complexity scale of your business while not necessarily growing your expense load.
And then that brings to a different question in my mind. You have some experience with venture capital funds, right? So how do those people look at your sector now, right? And what are some of the factors they consider? Give us some insights onto somebody is looking for raising funds, what they should be aware about.
In my sector in particular, it's been pretty bearish, to be honest. I operate in the capital market. I think for better or for worse, I think worse today, but better in the future. The first crop of InsurTechs didn't quite pan out. A lot of them went public at large valuations, and those valuations slashed by 60, 80, 90%. And as a result, investors, what they prefer to do is fund a cohort of companies, watch them bloom to maturity, exit at a great valuation, and then recycle that capital back into the next crop of companies in that same industry, all the while telling their LPs about the success they had with the first crop. And I think that ecosystem just didn't happen with InsurTech. So as a result, there's a massive reset occurring where it's a lot more kind of show, don't tell in InsurTech, where we can say we're going to achieve XYZ in 2024, and maybe in a different environment with different sentiment, people would give you a little more credit for what you say you're going to do. I think right now it's much more, what have you done? What's happening right this second? What can you prove?
They sound like they're talking like bankers who want to see what they always look back. Venture capitalists always look forward. So if they're freezing in your industry, as I would consider, they're struggling to think forward because it's so much safer to think backward.
I always like to think that investors are always weighing two things. It's how much do I believe your story, and how much will I pay if I'm wrong? My honest gut is that when we show our future is just a continuation of the trend line from the past, that we're not going to do anything tremendously differently from the past in order to achieve our financial objectives, I honestly think we're telling a pretty believable story. The problem is that we're not the first company to have told a story in this sector, and the last bunch that told a similar story didn't work. In fairness, I think we only have to continue our prior trend, whereas other InsurTechs had to make a sea change relative to their past performance in order to achieve their objectives. But nonetheless, when investors buy into a story and it doesn't pan out, there's a lot more on the line if they make a similar bet for a similar company in the similar industry and they're wrong the next time.
Based on the financial headwinds for capital and the risk side, the 100-year flood risk side of things, how do you manage as a tech company your investment and engagement through technology? And from a CFO perspective, what is it you have to do that's different based on the fact that you're in this particular scenario where other industries may not be when it comes to building and investing in tech?
Yeah, I think money is really expensive. And as a result, our objective this year is to get to cash flow breakeven. And I think we have a very credible path to get there. And a lot of our investments and a lot of the way we allocate capital this year is designed first and foremost to achieve that. So we're no longer reliant upon external costs of capital. We are internally funding, which gives us a lot more freedom and flexibility. And again, doesn't put us at the whims of where the capital markets are in a year or 18 months time. That means a lot less focus on investments that might pay off in 2 years, a lot more focus on investments that will pay off in 2 months.
Okay, so your technology choices are built around how quickly, as opposed to this is going to set us up good for the long term. It's more of a short-term decision making.
It's both. I would never say that we're short-term focused, but there's always a balance. You can do things that are short-term focused. You can do things that are very long-term focused, and there's a middle ground. And I think we operate in that middle ground, where we're trying to figure out how we can generate cash flow with the least amount of increase in our burn and to do it as quickly as we can. And maybe what we define a win is smaller in scale than if we were to invest a lot of money in a really brand new vertical that could deliver potentially a grand slam in 2025. Like maybe the scale of the win is lower because the scale of the risk we're willing to incur is lower. But nonetheless, these are wins that when you add them up, we believe that they are lower risk, lower use of our precious capital and will prioritize getting to a place where we're no longer reliant upon third-party capital.
So then, as a CFO, what is your take on organic growth versus growth through acquisitions, and how do you balance that? Because I think both is required, right? It's not one or the other.
I think growth through acquisition is tempting. I think anyone who's been to business school has probably seen at least one, maybe more studies about more times than not, acquisitions tend to not create value. You have to do a lot of things right to grow through acquisition. I think you have to identify a target that clearly is complementary to what you're doing. There has to be a really well-defined plan in advance on how you're going to integrate it, how you're going to achieve the cost synergies. You have to make sure that the value you're paying for it is reasonable, and that value is based on just a lot of things, but ultimately probably just supply, demand, leverage, all those items that enter into a negotiation. All those have to fall into place in order for growth through acquisition to be effective. When you're working at a startup that's already in the current day cash flow negative, you can do nothing and your risk of failure is omnipresent. You inject an acquisition into it, now suddenly your execution risk gets jumped up 3 levels. So I'm a believer in, first and foremost, prioritizing organic growth. Figure out, what are you selling to what customers? What are your distribution channels? How can you upsell your current customers with new products, adjacent products, and basically leverage what you've already built versus buy something brand new and hope that you can just hit the ball straight down the fairway with all the execution and synergy realization risk.
So you sell a lot of your insurance through agents, but how much of that, or what is your strategy on really selling it online? Because these people can find you pretty easily, because the kind of companies you're selling to, the smaller companies are typically run by 1 or 2 people, right? So if they go online, they can pretty much find you and buy insurance from you, right? They're more tempted to do that than talking to an agent. So what is your strategy on that front?
Fortunately, now from my vantage point, it's no longer theoretical. It's like the answer to that question is somewhat known. I think the first crop of InsurTechs tried very hard to go direct to consumer, or in this case, direct to the commercial consumer. And the results were not what everyone thought they would be. For one, the loss ratio performance on, if you're a customer that's proactively trying to go out and buy insurance, there's a good chance that you're doing something wrong, or there's a chance that you're going to want to claim on that insurance. So just from this intuitive perspective, you might be a worse risk in the first place. And then second of all, when you look at the cost of acquiring business through the agent network, you're paying 15% of premium. It's a purely variable expense, which means that margin can never blow up if, let's say, overinvest in marketing and don't achieve your results. However, when you go direct to consumer, you could overinvest in marketing and not achieve the results that you want. In fact, that first crop of InsurTechs that did try to sell direct to consumer, oftentimes the cost of acquisition was 100% of the premium itself. And that means that on day one, that this policy will, at least in the first year, will not be profitable. You're banking on the fact that policy will renew in year 2, in year 3, in year 4. But even that's no guarantee. It was a worthy hypothesis to explore. And I think it's been largely fleshed out. And I think for good reason, the second crop of InsurTechs, of which Coterie is one of them, is focusing on selling through the agent network.
Wow. So I think everybody thinks going online saves money, right? So you got a very different perspective of that's not always the case.
It was common knowledge. Identify an intermediary and cut out the intermediary and have more value retained by the remaining players in the ecosystem. Again, it's a hypothesis that I think was fair to test out. I'm glad that we learned this lesson, not with the capital that we've raised, but by observing the experience of others who've raised capital from other investors. But I think, again, largely this thesis has played out.
You mentioned you came through this corporate development, turnaround, going into distressed companies, and now you've shifted into this system building CFO, where you're creating something and staying with it through the process. I can understand as an entrepreneur that there can be a lot of similarities in this, but what really caused for you as an individual to go, I want to shift in this direction? from this side, working with stress to moving towards really building something?
It's very much a personal question as to what do you want your workday to feel like between Monday and Friday. And I don't fault a single person who wants to have a relatively stress-free 9 to 5. I realized that I was not one of those people. In my personal life, I love mountain climbing, rock climbing, anything with a little bit of adrenaline gets me excited. And I need that as well in my professional life. I like to be in environments where there's real stakes, where there's a clock ticking, where there's real consequences to decisions that are being made, where if things are not done right, the company could actually go out of business. I think that adds a whole lot of intensity, intellectual rigor, a sense that what you're doing is actually making a difference. And I think I learned that very much when I was working on the turnaround side of insurance. And I had a great time. I spent 8 years working at very large $1 billion plus insurance companies, solving really complex problems. I learned that there is something really fun about just solving complex problems, something also rewarding about communicating the results of my findings to the people in the C-suite who can then make the decision and feel confident because the analysis is solid and also the explanation of it is solid. And I realized at a certain point, I wanted to do this out in, I'll put it this way, it's hard to keep on finding distressed insurance companies to work for. You have to stumble across them. And the startup world provided a lot of that same excitement, except if you apply all the same skills, you can build something. You can build a company that's valuable. And obviously, if you're an equity holder, that could mean a real awesome financial payoff when all is said and done. Move to the startup world where, again, your back's against the wall, you're burning capital, you're constantly making decisions that are, sure, you can save money, but you're also going to probably burn an opportunity. Or you can spend money to pursue opportunity. If it doesn't pan out, you just spent money with nothing to show for it. And all of those decisions just carry a ton of consequence. And I love it. I love the excitement. And I couldn't imagine myself doing anything else.
Very cool. We get that as businesses, small business owners. As Jay puts it, he never likes to back away from a challenge. Bolt today was birthed under that mantra was, oh, this is challenging. Let's do that.
Yeah, it's interesting to wake up every day with like the sword of Damocles hanging over your head and to say this is what I chose for myself. But hey, that's who we are, right?
Exactly. Cool. Jay, do you have any other questions?
I would like to really understand, are there any specific focus tools that as an internal systems you use because you deal with a very specific market, or you have all homegrown them and created this operational systems for yourself?
I think we've tried to be really capital efficient with how we use existing systems that work, but also how to append onto those systems our real proprietary secret sauce. So I'll give you an example. We use Salesforce, I think, a lot more so than most insurance companies would. And that's because insurance at its core is you're selling. It's a B2C business. We as an MGA are selling to agencies who are then selling to customers. And in order for us to do that better, we have to really understand the journey that all of our agents go through and all of our customers go through, because each of them have many touch points with us. And we can record every step in their selling and their buying journey. We can see what sort of interactions they have with us, what they do at those interaction forks in the road. And then we can use that data to analyze trends, figure out maybe a certain type of customer in a certain geography will fall out of the process at a certain point when a certain question is answered a certain way. And we're able to capture all of that in Salesforce by connecting Salesforce to the systems that quote and bind policies, that onboard agents, that handle the customer service requests that come in from customers after they've bound, that track the data and the interactions that customers have with us when they unfortunately have a claim. Because each of those different systems has different information, and each of those pieces of information paint a different picture of that customer's journey. And by using Salesforce, we're able to aggregate all of it into one central place and access, again, that full journey for a customer in one CRM.
And are you using any out-of-box analytics tools? Because AI is everywhere now. So what AI are you using should be the question.
Yeah, we have a 14-person data analytics team, and we purchase data. We spend a good chunk of our budget on purchasing data because, back to the start, our business is built on allowing agents to quote and bind an insurance policy instantly. The way we do that is by cutting out the need to fill in that information manually, which means we're getting that information automatically through data feeds. So that data that we bring in is what we use to basically form our view on a given customer, figure out, do we want to insure them? And if we do, what's the right price? But of course, that data is available to anyone who pays for it. We're not the only customer for any one of our data vendors. The real secret sauce on our side is how we create systems that allow us to, let's say, compare the same data point from multiple vendors against itself in order to arrive at confidence intervals, confidence scores for a given data point to decide how much you want to rely on this given data point. Or let's say that we have a lot of data on a certain customer, but certain points are not there because the data just isn't complete. Can we look at similar profiles of similar customers and see what that missing data point was from those similar customers and impute onto that new customer what we think that characteristic is, and then price the risk on that imputed data point? That's where a lot of the AI ML comes in. Basically, just again, you can buy data, anyone can buy data. The real challenge is how you manipulate it to create models that can form a really nuanced view of any customer within seconds and offer them an insurance policy priced correctly.
I remember coming from a finance background as well, like looking at a business's P&L like you would in a distressed company, coming in and looking at all the financials and beginning to get a sense of what's going to happen and what behaviors you can expect when you get there just by reading the numbers. And it's like the AI systems getting closer to that allow you to make better choices around how you price, which of course is the game in insurance. So I think that's pretty interesting.
That's right. And it allows for scalability. Again, if we're a high volume business, we're selling lots and lots of very small policies. And therefore, in order to make these decisions, if we had humans analyzing each individual application, making these decisions offline, the human, like the personnel expense to run that part of the business would just never allow us to become profitable. But by automating it with technology, we have basically a fixed cost structure that allows us to analyze the risk of an infinite number of customers and price them and offer them policies. And I think that's the key. In this sector of the insurance industry, it's all about achieving break even through an economy of scale, a fixed cost overhead structure.
Excellent. Anything else you'd like to share with us about your journey that you think is relevant or helpful for someone else to know when it comes to how, as they're designing their journey towards becoming a CXO like yourself, what sort of things speak out that help you through your somewhat linear path?
I know it's probably kind of trite, but just expect to have lots of setbacks, expect to have to grind it out a bit, expect that your first try won't be successful, expect that you're going to have to fall back a few steps before you ultimately jump forward. But all those failures are what you learn from, and it allows you, as you progress in your career, to, I think, just have the wisdom of having seen more and having touched that third rail and know what it feels like, but also just have like the calm demeanor that when you do encounter new challenges, you'll stop, you'll think, and you'll just address them calmly and rationally. And I think that's what business really is. It's keeping a level head as the inevitable frictions and challenges come your way.
That's good advice.
Yeah, glad to share.
Pleasure talking to you, Marc. Thank you for your time.